today's video, we discuss Zero DTE options, why you should consider choosing a direction in this market, and what are some examples that are working for our coaches. Listen up. For those serious about becoming successful, consistently profitable options traders, now is the time to build skills in technical analysis, market analysis, and applied volatility to get those results. We have multiple memberships, starting with our Go membership that teaches rules-based trading and our Pro membership that teaches more subjective trading. For more information, go to lockinyoursuccess.com/memberships.
Okay, so we had a question. This is just the way I approached answering this. There's, as with most of our topics, there's many different perspectives, POVs, and ways you can approach the market. But this is what I came up with and how I trade the shorter dated stuff. So here's the question. Basically, she's asking about zero DTE trades, and in my experience, she says they tend to be directional, given the time frame would allow a more limited number of adjustments. John is doing a lot on the TA side, and is really starting to make a difference for me. That is great to hear. I would also like to hear his opinion on the choice of trade to put on depending on the scenario. If we limit ourselves to options, we have a lot of possibilities: in the money, at the money, or out of the money options, spreads, BWBs, or the Hammett BWB, which John demonstrated on longer time frame. It would be great to take different examples of trade setups and hear John describe his preferences. I agree with her from the standpoint of, in this market, particularly since the November lows, which it's been extremely bullish, like .com 1999 bullish, almost. I don't think anything will ever be that bullish, but as much as 2020, 2021, right? So that's context, that's narrative. Understand that. What do I mean when I say that? What I mean is you're getting monster moves, trending moves in both directions. I don't want to be in a spread. I don't want to be in a containment strategy for that. I want to be directional. I want to be unlimited, uncapped with what I can make. Is that what I would have done last summer? No, it wasn't happening as much. So context and narrative matters. So what I'm doing is the directional plays, like I said. And for me, not a right or wrong, it's a preference. It's putting a story together and deploying what fits you. I'm doing out of the money calls and put singles. I'm doing zero DTE and SPX and QQQ. I'm doing 1 DTE. So I'm seeing a setup the day before and entering expirations that will expire the next day. And I'm also doing futures ES on the overnight 1 DTE. So if you see a setup there, I can deploy, which, by the way, can be extremely powerful because you're not subject to the 3 or 4 p.m. cash close to get your typical options on that we play. I can put this on at midnight. I can put it on at the 5. It opens at 5 o'clock for me. If something has set up, we've got a bounce, or the market has tanked overnight for whatever reason, then I can deploy a play. And then EWE is end of week play out of the money SPX QQQ. And what that is, basically, the pattern has been for at least 6 weeks, if not longer. We rally Thursday, Friday. We chop, digest Monday, Tuesday, Wednesday. So Monday, Tuesday, Wednesday, I'm looking for some sort of a pattern or setup for me to get long for Friday expiration. So that'd be an end of the week play. Why do I choose these? Why SPX, QQQ, and more importantly, why the 0 DTE, 1 DTE in the end of the week? It really limits my cost from using the out of the money. Virginia had mentioned, you can go in the money, you can go at the money. I'm dealing with a lot of costs with tons of gamma, and I don't want it to completely dominate my time during the day because, I'm trading short-term futures. I'm swing trading stocks. I've got our campaign trades going, and I'm doing this. I don't have the time to manage something that has, $1,000 of cost in it. So we'll get into what the cost looks like, but they're really minimal. And it's easy to estimate my exit price. And I hope you guys are doing this in your for any trades, but particularly for singles. If I want to know if I buy something for $2 in the SPX and I think it's going to go up 30 points, the SPX, in the next day, what do I think that's going to go for? All you can do is look at the options chain, go up 30 points, up or down 30 points, and there's your price. And I'll put in a limit order, good to cancel for that price. No management. Don't have to do anything. So I already know it's going to be. And that happens more often than not. I also like the out of the money in this kind of market because of the increasing rate of gamma. I know the definition of gamma is an increasing rate of delta. It's like the accelerator. But gamma also has, and I don't know what the third or fourth derivative Greek it is, but it also has an accelerator to it as well. You have that time. Since there's no real time in it, it's all delta, it's all gamma, and it can be quite exponential when these go in the money. And a lot of these, are 50, 60, 70 points out of the money. When they go in the money, I mean, you could go from going for $2 to $1,000 with a 10-point, 5-point move in the underlying. Whereas if I'm already, say, started the trade as a 70 delta, now it's gone to a 99 delta, I'm not getting any more benefit. My benefit has stopped. It's basically, it's a decreasing rate of gamma, so I'm not getting the benefit. If we get just a monster move, I want to continue to participate in that. And the third reason why I like these is I put these on at a cost where I could not care less if it's a total loss. A lot of times I'm just busy or I've got an appointment and I'm like, I bought an SPX call for $200. It's trading for 50, and I got someone called or I got an appointment. I don't care. I'm not just stressing out about closing it out to save the $50. Okay, so that really speaks to acceptance of risk and the purpose of the trade, right? It's not why I'm not in this to make $50 or save $50 or make 200 or de-risk it and all that. So really that speaks to just accept the total loss, whatever it is, $200, $400, $500, $100. And then it also allows me to not overthink it when I do have a winner on my hands. So, when you're dealing with these trades, you've got a tiger by the tail. Because you get a 20-point up move and a 5-point pullback. Well, you've given back quite a bit. And so you have to be ready to sort of manage that. And that's why I do things like, and I'll show you later, or we can talk about it, this auto trail stop in TOS, which is super effective, especially in these very liquid markets, SPX, QQQ. So I can just let that go, or I have that resting order going, right? It does take some attention once you've got it going your way, but those are some ways I mitigate fretting over it because I've accepted the loss. In other words, if it's going against me, it's just probably a loss anyway. But I'm not going to stress over saving a dime. And then the fourth is I can position size it in such a way that I like to have at least 2 contracts. So I can scale out into targets. And those may be technical targets. It may be dollar targets. A lot of times, just because I've been doing this for a while, when I buy something for, say, $1.50 and it gets up to $1,000, the value, that's probably a good time to take some off. And you can look at the charts, you can do all that, but at some point, wouldn't recommend any other environment. But when your gains can evaporate so quickly, it becomes a more important variable. So I might do that. Typically, that's going to line up with a technical exit anyway. In this example, I've bought 2 contracts, $200 a piece. I got $400 in it. I take one off at 1,000. So I've cleared 200 in my pocket. I made 600 on the contracts. It's great if you can have 10, right? Just depends because I lost my train of thought.
I'm sorry.
That's okay. If you only have one, you are going to overtrade the P&L. So let me go back to the example. Let's say I buy one contract for 200, market's going my way, I'm up $1,000. You're going to you're going to really start dreaming up reasons, self-negotiating as to why you should take the money. Whereas if I've got 2 contracts, I get to just take the money right there, half of it. I take one off there. And so it keeps me from doing what I call that self-negotiation, which is you kind of making up stories as to why you should take an action instead of based on your trade plan and the what's happening. I got 2 contracts. When I get up, I know I'm going to exit one and carry the other one for the home run. Does that make sense so far?
It does. It makes a lot of. If you have an idea of what your average win versus your average loss ratio would be.
Yeah, I'll get to that in another slide.
Oh, okay, good, cool.
Yeah. So at the end of the day, you want to determine context, right? What's the overall narrative? What market are we in? What's it been doing? And I can expect to continue to do that until it doesn't. And accept the risk that you have on, because that's first and foremost. If you have on too much risk, you're not going to let this thing do what it needs to do to make the bigger wins.
And I would probably add to that, if you get too attached to your profits, you're also not going to allow it to happen.
Yeah, and that's why I like to scale out.
Yeah. Nice.
We don't do that in our normal campaign training, but this, I think, in fact, any professional trader that day trades futures or stocks, it is, if they're not scaling out, they're not a pro. I'll just say that. You have to take profits along the way for multiple reasons. So these are just sort of a hodgepodge of comments that I want, and I call it this and that. So I use the ES futures options overnight in case a setup presents itself. And I don't want to be constrained by the cash close in order to put this stuff on. So that's a nice feature. I'm going for the home runs here. I'm not doing scalping wins. If I put on, a trade for $200 and it's up 400 and I've made 100%, that ain't what I'm in this for. We're trying to make monster gains. So I don't want to get constrained by that. And I'm not, to that point, I'm not trying to de-risk, right? I'm not going to spread it off in this environment. And this is key. In this environment, it makes no sense to do that. The profits are too huge to do that for this trade. But, if you're in a choppy environment, let's say I might put a call on 1DT rips, but I know it's a choppy market on a broader context. And then I might sell a call against it. Now I'm in a spread. I might do that, but not in this environment. The win rate right now is about 60%, which is way higher than you would think. So it sounds like I'm in alignment with the market. My read is good. I haven't done the math, but just yet. I've got my spreadsheet isn't complete, but you can already see with the huge average. Well, you haven't seen what the results are. The average wins are, I have that in here. Oh, maybe it's on another slide. Anywhere from 3 to 7 and up to 10 times your cost. So your average wins are huge and your average losses are small. So what's your win rate need to be to make money? Not very big. 20%.
Right. You could probably make money at like 30 to 40% win rate, or
maybe even
less.
lower.
Yeah.
So, yeah. Exactly. So I would expect this win rate, would normally be a little bit lower, but it doesn't matter. I'm still going to have a high profit factor and very positive expectancy if I'm holding for the larger wins. I also utilize then to hedge a long swing portfolio. I do some short-term swings and a lot of the momentum names, the can slim names, whatever the flavor of the month is, the AI, the semiconductors. And to hedge that portfolio, I will do Zero and 1DTE puts. And as a matter of fact, it was almost a masterclass in doing that yesterday. We had a 2B reversal on Monday. Right at the end of the day, we closed down at the lows, but we'd made a new high, 2B reversal, put on some puts, put on 2 yesterday, closed them out for $2,000 profit, and it exactly covered my open position give back in the swing portfolio. And then the swing so I booked that. The swing portfolio is back up to $2,000 today. So that's another way you can utilize these products. Got a comment, John?
No.
Okay.
I'm reading your thing while you're talking.
Yeah, so there was that 2B reversal, snap and crack, look above and fail. They're all the same thing on March the 4th, which was Monday. So that was a signal to get some puts. And you didn't have to do it as a hedge. You could have just done it as a swing trade, right? But that was the purpose that I used them for. And actually sold them, closed them out at support yesterday, and then got long. The end of the week calls or puts are great for, like I mentioned this earlier. We tend to balance, go range bound, chop around Monday, Tuesday, Wednesday, give or take, and then break away on Thursday, Friday. So I like to be positioned for that. And again, if it doesn't happen, it doesn't happen. I don't care. No drama mama with these. Don't give a flying F if they go out zero, because you have tons and tons of opportunity, meaning you get a lot of reps. You can do as many of these you want a week. I wouldn't overdo it. I mean, you're waiting for signals. I might get 3 or 4 signals a week. So it's not like there's a ton of signals firing off, but 4 a week, 16 a month. I mean, times 12, how many is that a year? There's plenty of opportunity. It's almost like you kind of, I don't know what it is, but it just doesn't matter. I don't care if they go to zero. It's such inconsequential money. I guess one could argue maybe you need to up your size, but that's another conversation.
Well, then you trade crappy, and then you're not doing well. So
probably, right? Yeah. I mean, we always know the laws of market dynamic and the cosmic laws are, when you increase size, you are going to lose. So if you want to avoid losers, don't ever increase your size. I mean, I'm half kidding, but it is sort of true. Like, literally, I think there has never been a time I've ever increased my size in any kind of trading that I didn't go on a mini losing streak. Right. It's partly mental, but the other part, as John knows, is the market was a little bit of a sidebar here. The market was in alignment with whatever you were doing, and so as soon as you're in a streak, the market's going to change character most likely, and then whatever you were doing is not going to work. So that's usually why that happens. It's not some mystery, really. And you're just not adapting quick enough, or you adapt at the wrong. You increase size when you should be adapting to a new context. Other traders I know will actually do not singles. They'll do spreads and zero DTE condors and wide butterflies for range bound days. I don't really like doing that in this environment, because what we're getting goes back to higher time frame context and narrative, is you can get a range bound day and then it falls out of balance at the last hour. So there's nothing worse than having something finish right in the middle of your condor or butterfly, and then at an hour before the close, the market takes off. I don't want to get into that, but they work, and you can do them. I just don't think this is the best environment for it. Last summer was perfect for it. And then I'm going to show you a little bit of an example of what you can really do. The NVIDIA earnings day, I don't know if you guys remember that, was really super wild. We were coming into support, a major support in both SPX and NDX. And then for whatever reason, about an hour before their announcement, the market really caught a bid. I reclaimed a level that I'd been looking at, and I grabbed some 1DTE SPX calls for the next day. And I also grabbed some end of week. So I had 4 of them going, 2 for 1DTE, and I think the end of a week was only 2 DTE, so it was only like the next day. And the first set made 7,600, a little typo there, and the other one made 8,600 in 2 days. It wasn't that I was really looking for, I can show you that I wasn't necessarily looking for the giant catalyst out of NVIDIA, but I knew that would be the wind behind my sails, because it was really just like I always do. I put these on, and and I'm primarily doing calls because we're in an uptrend. I'm not shorting. I think that's such a plague. People trying to short trends is the fastest way to go broke, and lose your mental edge as well. You won't go with the trend. In any case, that just turned out to be, I just remember it as their NVIDIA day, but there was more to it than, I don't want people to get confused and say, oh, I was making a bet on NVIDIA earnings. Absolutely not. I had no idea. I don't remember what it caused the market to have one of its biggest days, certainly the biggest day this year, but if not in the last 12 months, just because of, I guess AI is going to be the new .com.
Yeah, it sounds like it.
Yeah, my point being is that happened to be a catalyst that sent these into the stratosphere, and it's just an example to show you what is possible.